Welcome to Stock Cheat Sheets, where we trend, rank, and grade stocks and exchange traded funds.
Welcome to Macro Monkeys, your macroeconomic weekly podcast, along with the folks who subscribe to Cheat Sheets. And we also welcome aboard the folks who follow us on Chaikin Analytics. We actually call ourselves Chaikin Power Users. It's a lot of different things we represent, consolidated into one powerful video. I'm Mike O'Connor, first half and the uglier half of the dynamic duo with Double A from Denver, Colorado. How you doing, Double? What a week in the market we've had.
What a crazy week it was, Mike. How are you?
My face is reddened by the amount of wind directional changes I've been getting. Or I've been drinking too much. It's one of
the whiplash, or both.
Yeah, we've gotten some whiplash. So, let's start where I always like to start, which is talk to me about of course, what you do for a living is varied, but you're a mortgage expert, and you got your license over a decade ago, and you've seen it all here in the last decade. What has been going on in the mortgage market?
To put it in a word, nothing. Volume is dried up. Business is slow, to say the least, across the board. And even competitive rates on 30-year mortgages are over 7% now. So it's a challenging space to be in. Although at least here in Denver, and I know real estate is very geographically sensitive, but even in Denver, though, despite that, home prices remain relatively stable, which is, I think, surprising to a lot of people.
Yeah, and I think when we talk about inflation being tamed, people have this idea that prices are somehow going to come crawling back down to pre-inflationary lows. Well, I got news for you. That never happened in the 70s. In fact, the only thing that changed was the difference in price moving forward. Instead of going up, 10% year over year, or now I guess we're about 8.1, 8.2, something like that.
8.2.
That we're hoping that it'll slow to 2%. So for those of you who haven't gotten a raise, a 10% raise to keep up with the last year, it's going to take you 5 years of 2% raises just to equal the damage done by 1 year of excessive inflation, because we're not going backwards.
No. And so speaking of inflation, how about we start there and talk about the CPI report for just a few minutes? I know, by the time this is published, it's probably been talked about, a lot, but I also think it's worth spending a few minutes on as the headline number came in at 8.2, which was month over month, 0.4, which was nearly twice what was expected. Core also up and now sitting at 6.6, also much hotter month over month than was expected. And we're starting to see that inflation is not only obviously becoming sticky, but broadening, which is concerning.
Yeah. So let's orient people in space and time. The average forecast was for about a 0.2% tick up in the consumer price index, core and non-core. And we actually had a surprise to the upside. It was double analyst expectations. Yeah. We moved up 0.4 month over month instead of 0.2. And that brought us to above 8% for the third or fourth month in a row. I think it's the fourth month in a row, down from 9, to be fair. So the overall, I think inflation rate's about 8.1% year over year now?
8.2 is where we're at. Yeah.
8.2. Okay. So a lot of investors, and this is at least the theory behind why there was that massive reversal in the stock market. Remember, it was Armageddon in the morning and happy days are here again by the afternoon before.
I absolutely want to talk about that because I found that so interesting.
Before Armageddon returned again on Friday. And so one theory is, and of course I have my theory, I tend to believe that anything that's going to be jarring to consumers before the election is being dealt with by the people who have the levers of power, their hands on the lever of power in Washington. And to the extent they're able to manipulate the timing of Treasury purchases, most people don't understand that even in quantitative tightening, there's going to be days where the Fed buys. It's just a question of they're net sellers overall, but that doesn't mean that they can't time things. Mm-hmm. And so one of my theories is that they just happened to be big buyers of bonds on the day that the market was moving below support. And that helped create a bit of a buying frenzy, fueling the thesis that maybe inflation had peaked. That is, I think, what the headline writers for the financial markets are concluding happened on Thursday. Of course, they have no explanation for why we then suddenly reversed back down on Friday.
I agree with that. There's definitely there's the smell of some government entity intervening here. There absolutely is that smell. To the extent
that they have control.
Yeah.
Even if it's smoke and mirror control, they're obviously using it. I mean, Biden's pulling the strategic petroleum reserves tactically right now for political reasons.
But also consider something I've considered is in regards to the swing. I mean, we opened 1.5% lower and closed 1.8% higher. It was one of the top 5 reversal days in history. One of the things I'm considering, and tell me what you think of this, is going into that CPI, because we talked about it last week where we were dropping a pretty low number from last September. So just because of base effects, there was a potential for it to be what it was in the end. And so because of that, I think a lot of traders got short or had on short positions. And then when it came to be, and we saw a 150 handle move at the open, those short traders then covered their shorts. They sold their puts. They did what they had to do, which then triggered a counter move by market makers to then cover, and basically it became a feed on itself rally up, and it was due to nothing other than market structure.
Yeah, I tend to agree with that. And I think, listen, there's always the talk about trading desks at the big money center banks and others who control enough of the market, who all went to college together and are part of that bro financial service system. Wink. They get together and can time things where, hey, we know this is going to roll over and this is devastating for the market, but let's take advantage of a swing up. Are you in at 8:01 on my cell phone? I'm not talking to you on a landline. I'm sure there's that kind of gamesmanship. And that's why for retail investors, it's never a good idea to try to play that game. You're just not invited to the party. So it's better to step back and let it unfold. And then
and once it starts, it kind of feeds on itself, because there's a starting point. However it starts, I don't disagree that what you're saying is a possibility. But then once the move starts to happen, everybody sees it and tries to get in, which then just exacerbates the move.
I'm a big believer in the weekly candles during the kind of markets we're in right now, which I think are very much headline-driven markets, right?
Agree.
It's the general sentiment is lower, with periods of reprieve that are generally tied to headlines. Sometimes it's, oh God, good news that the economy is crashing, which means the Fed is going to reverse course. So it's good news. We talked about this last week to a great extent, the old good news is bad news and vice versa theory. And whenever we have markets like that, the best thing to do is just look at the weekly candles and stay out of the foray. At least that's what I've been doing with my own directional assumptions.
I agree. I think turning off the TV, turning off the financial media, it clears your mind. And at least speaking for myself personally, it's made me a better trader and better investor by not listening to really any of that.
Yeah. In fact, I think the first 10 minutes of our hourly video is almost criminal in our tendency to wax what we think, where both of us know that we have about a 50-50 shot at being right.
Yeah, it's true.
In the long term.
It's true. But I think it is good just to discuss these things.
Sure.
CPI matters, people understanding market structure and how these things can happen. That I think that really matters. And that's not talked about nearly enough.
I agree. At the same time, I think both of us could look each other in the eye and say, I am not going to retire 1 year earlier because of my ability to trade around Fed announcements.
Yeah, it's probably true.
Yeah,
it's probably true. Yeah. So I wanted to ask, the other thing I wanted to mention is the fact that the 10-year, which I think, the bond market obviously is very important here. The 10-year is struggling. So a Thursday on that CPI release, it did put in a slightly higher high, but reversed off that and, closed the week below it. So what do you make of not only the 10-year, but just the bond market in general? What do you make of the action in there?
Well, it's going lower and interest rates are going higher. And that is the primary driving force. So the question becomes, when does the bond market take control back from the Fed, right? And I would say that we're getting close, AA. I tend to agree with you that we may have a fake out move. Like, for example, I think that, for those of you who watch the 10-year note futures, there was a big tussle at around what would you call this? I don't speak tickeries, but around the 110 mark on the ZN, give or
Okay.
take, 115, 110 area. There was a break, and I think we'll probably end up maybe returning to that broken support line. But after that, the question is, when do we form a double bottom on the bond reversal, and when does the interest rate become enough to where people are willing to hide out for 4% or 5% rate of return? Because I think most of us aren't thinking we're going to get that out of the stock market anytime soon.
And we're certainly not getting it out of our, savings accounts, although those are starting to catch up with the reality of higher rates. And since most people probably look at yield and not bond price, which is what you quoted, I think that figure you quoted where that tussle occurred is right about 3.3, 3.5% on the 10-year.
Yep. Let me show you where I think how I think the rest of the stock market ends up catching up with what's going on in the treasury market. And that is XLU is probably the best example of the market starting to price in the risk-free return of the 10-year note, right? And we have to call it a risk-free return, right? The federal government, the very last thing that will get defaulted on is the payment stream on the 10-year. I mean, don't say never, right?
But I would say if your 10-year note gets defaulted on, you probably have bigger problems than your 10-year note getting defaulted on.
That's right.
Yeah.
And utilities is the first to go, right? Because that is generally considered a yield play. And utilities are paying. And I've been using one of the software products that we endorse and recommend is Chaikin Analytics. And of course, Chaikin Analytics is deeming utilities very bearish. But I'm able to actually, you know what? They've changed.
And just for a refresher, can I tell folks, utilities, of course, high yielding, right? So it's a means to generate a pretty decent yield.
Yeah, that's where I was going.
Okay.
But the dividend yield now is only 3.22%.
I see.
And what is the 10-year note paying? It's 4?
10 is paying 4.01.
Yep. So why would you hang out in utilities when you can pick up a bond that pays 25% more?
Right.
Better than 25%.
And to your point, the price in utilities is reflecting that very argument.
That's right. Utilities ETF, literally since the beginning of the month, maybe last week in September, has moved in a straight line down from 78 to 62. And remember, this is a less volatile, it's considered a low beta ETF, but it's already broken support. And I would say there's a good chance if this follows along the technical measurements, that it might have at least the range that it's already traded down to go. It all depends on interest rates at this point.
Right. The other thing, real quick, I'd like to talk about is energy, and energy has backed off, or it had backed off quite a bit, and the CPI report last week reflected energy was negative 1 point something. For the month of September, but it seems to be getting a little bit of. Would you agree that it seems to be getting a little bit of a bid here?
Oh God, I think that's the future. That's going to be the future story. It's a post-election story, but despite that, gasoline prices, especially in the parts of the country where the refined distillate product has to get trucked to the furthest, like you're hearing horror stories about the Pacific Northwest and the West Coast, dealing with $7 and higher gasoline.
Yeah.
Now, of course, there's gas tax and all that, but in general, it's the rising cost of diesel on fuel trucks, but also the lack of drivers for the trucks. So wage inflation. So the extreme parts of the country that are furthest away from the Houston distilleries, they're going to feel it the worst. But in general, I think we're just getting started on that, because you and I are big fans of relative strength, AA, and we've just completed an analysis that you can see if you go to stockcheatsheets.com.
Stockcheatsheets.substack.com, right?
Yeah, I'm sorry, stockcheatsheets.substack.com, where we do a relative strength analysis, and we look at the major price, not the actual trends of price, but the price changes relative to other ETFs, and we're able to kind of rank them in a sort of a stack to determine, where the market is putting its eggs, so to speak, almost in advance of price moving. You get to see the changes in velocity first, right? And when we do that, and we track, there's 50 different ETFs that represent the different buckets that would represent the global economy. And when I mean buckets, I literally mean that. We've got an ETF for the dollar and the euro. We've got an ETF for gasoline, an ETF for crude oil, an ETF for world stock markets, for Asian stock markets, for Australia, for Canada, for Eurozone. We have a ETF for Bitcoin. We have an ETF for soybeans. So literally these 50 ETFs cover the global economy. For obviously we could do this with futures contracts, but this is what most people know. So we try to distill things down into a common language. And so then we stack rank the stuff and we trend it to figure out what prices are moving bullishly, what are moving bearishly. And, I won't give the headline away. You're looking at it. I think you can see my screen right now.
Yeah, I can see it. And we'll
What do
do
you
play by
see?
play.
Yeah. Tell me, what do you see?
I see energy at the top there.
Yep.
Gasoline, and energy.
Yep.
Yeah, 100%.
Not all of it has moved yet price wise, but when you look at, let's take gasoline, for example, we tend to not put too much weight into relative strength changes until we get to about the 3-month mark. And between 3 and 6 months, when we see big changes in relative strength, we know that price is coming next. And so gasoline, I think, hit a low about 80 trading days ago. So it was about 4 or 5 months, roughly speaking.
Yeah. Okay.
But it has rocketed to, when you look at gas 50 days ago compared to today, it is the eighth strongest ETF in terms of price performance relative to everything else. These other 50 ETFs we track. And DBE, which is an ETF that essentially is tied to futures contracts involving Brent crude, U.S. crude, home heating oil, gasoline, and natural gas. And that has moved from a low 80 trading days ago of 26th, 60 trading days ago was 17th. When I look at 50 trading days ago, it moved to 7th. And when I look at the last 10 trading days, it's 2nd. And then we can do this for biofuels. We can do this for just U.S. crude. We can do this for, DBC, which is a broader commodity basket that includes everything from energy to foodstuffs to metals. And all of these are clustering right at the top of the stack. But it's AA. It's the ones connected to fuel, to fossil fuel in particular, that have something beyond relative strength changes. But what I'd call an institutional commitment. For those of you who subscribe to cheat sheets, know I refer to this often as buying pressure. But if you look at the stack of 50 ETFs, there aren't too many places where the buying pressure effect is in the green. And what do you see when you look for the strongest buying pressure, which we like to think of as Chaikin money flow scores of 0.10 or higher? There's not that many.
Yeah. You know what I'll say about this, and this just dawned on me, I want to share it, is that even if you're
just to complete the thought then,
Yeah.
UGA, DBE, and BNO are the only ones with a 0.1 or higher.
And all energy.
Right.
All energy. And that's kind of the point I wanted to make, is that even if you're not a trader and you're listening to the macro podcast, and you're not a trader, this tool that you created here, the stock cheat sheets, is an amazing macro tool, because nothing expresses macro sentiment more accurately than price.
Yep.
Right?
And price competitively ranked.
Right. Exactly.
Yep.
So even if you're not a trader, this is a great tool to kind of get a sense of macro moves across the world. Very cool.
And the only other ETF in the commodity space that's coming close to the kind of money flow scores, though we don't yet have what I'd call relative strength. We don't have a very dynamic change in price yet, but base metals, which are the non-precious metals, the kind of stuff that factories use to manufacture, think things like lithium or platinum or cadmium, things that go into catalytic converters, go into batteries. That stuff is starting to rotate into favor, although it's very light, but it's the money flow again. I'm sorry. It's base metals. So non-precious metals. We're not talking about silver and gold. By the way, silver and gold haven't happened at all. Would you agree with that? We've kept waiting for them to happen.
I've said it before. Gold is the disappointing child that had potential and wasted it.
Yep. And I think if there's no other measuring stick than your disappointing child failing to achieve the kind of overperformance we were expecting, that's probably the strongest indicator that inflation is definitely not going to run away out of control. Now, the Fed is not going to be able to, the Fed can't print a wealth but it can take it away. So, but the Fed isn't going to be able to affect food prices as much as I think they'd like. They might be able to affect truckers' wages. That's about it, though. They're not going to be able to. They have no control over what gets grown and exported out of Ukraine. We don't have enough of a effect on the world market to totally control energy, but labor costs and housing costs are the two things we can control. And so the Fed is probably going to do a good job of depressing those two categories.
So it's not that I don't agree with you, but I want to push back just a little bit on the housing. And I know it's early, and I know these things take time. But even at 7.25% mortgage rates, housing prices in the market in general hasn't slowed in the way that you would expect by doubling the mortgage rate in less than a year. And I'm just wondering out loud, without anything to back up my words, is if this wealth gap, which the Fed has undoubtedly helped to exacerbate, if that wealth gap is now working against them, and the people on the higher end of the wealth gap, they don't care. They're paying cash, or they can float a 7.5% mortgage. They don't care. And it's right. The Fed doesn't have the control they think they have is kind of the point.
Well, I guess it all comes down to the housing numbers, right? That's ultimately, I just don't know how much lag time there is between rate hikes. Although they've been very aggressive, we've never seen rate hikes like this.
Yeah, never
in our life on this planet. With one exception, I was 18 years old when Volcker, I think, brought us from 10 to 20. But we've in effect quadrupled interest rates. Volcker only doubled them, or at least what I remember. I remember that big jump from 10 to 20.
Yeah, I know the data is lagging, and it's probably 6 months out. But we now have 6 months of higher mortgage rates, although not current level of.
Well, you're a lot closer to it than I am. So, do you have a sense about? And again, I realize that real estate is very market specific, and Denver is going to be a very different market than, let's say, a dying industrial, town in Ohio. There's going to be. There's a lot of different factors that go into real estate, but what would we expect to happen? Would housing prices, in the worst of times, like in 2008, did they get cut in half? Did they roll back 10%? Did they just stop going up? Give me a sense of what rate cuts have done to housing prices in the past.
So,
if you know,
I'll say what they've done this cycle is that they've cut out a lot of the exuberance and speculation, but they haven't cut prices in a meaningful way. At least in the market I'm in.
Got it. So even though the stock market's down 30% ish,
yeah,
and the wealth effect is definitely going to, I mean, hell, I can't afford to pay cash for a Denver house, but let's suppose I could. If I were doing it because I felt rich in the stock market, I'm 30 cents light on my investment accounts than I was compared to a year ago. And so for me, that would change my behavior. But, the question becomes, when do we absorb the changes in cost for housing? Because isn't part of it too that the access to money is going to get tighter as well? It's not just can you afford it or not. It's will the bank give you the loan?
Lending standards are tightening up, and also I think liquidity is drying up. I think that there's less appetite for investors have less appetite to buy mortgage-backed securities, for example, which then just exacerbates the upward pressure on the rate, right?
For those of you who are following the video version of this, and we'll try to explain this as we go, we're looking at relative strength of the different fixed income assets that are available to consumers and institutions. And of course, these fixed asset ETFs would just sort of represent these different buckets of money. And in good times, it would be fair to say that the highest risk stuff that tends to pay a much better yield, especially in good times where interest rates are low, that things like high yield and junk bonds tend to do extremely well, and they get roughed up during tough economies. Whereas safety, things like cash is a position, and so the ETF UUP, which is obviously also represents a international demand for dollars because of the U.S. dollar's place as the world's reserve currency. Many times to buy oil, you have to, like from Saudi Arabia, you have to actually convert your currency into dollars and buy, at least for now, do that. We also have Treasury inflation protected securities. We've got mortgage-backed securities. We've got corporate bonds. So there's all these different buckets where you get paid a fixed rate of return in exchange for investing in a particular tranche of fixed income. And the trends that we're seeing, AA, we're definitely finding we're going lower on the risk curve for sure.
Yeah, I think that I mean, we see it here. If you can see the screen, the appetite for these instruments is drying up.
Yep. Municipal money markets are probably the best performing fixed income asset class, outperforming most everything else, and has a money flow score above 0.1. No trend right now. Remember, relative strength doesn't necessarily equal going up, right? It's just that these are going down less or staying sideways compared to other assets. Whereas the TLT, which is the 20-year treasury bond, that's one of the worst performers. So people are favoring the short end of the curve, money markets, highly liquid fixed income, and they're shunning tying up their money for long periods of time in fixed income. So mortgage-backed securities, I think AA, that falls into the latter camp. Yeah. And we're seeing a rotation, an extreme rotation out of it that began probably, what would you say? I mean, I would say 90 trading days ago. So that's going to be, more like 15 weeks. 17 weeks, something like that, 17, 18 weeks.
And if I could, I want to take just 1 second and explain at least part of it. Of course, there's many reasons why, but one reason I think, at least in the mortgage space, the mortgage-backed security space, that these things are getting sold and there's less appetite is refinance risk, which doesn't get talked about a lot. Is if you're buying a house right now at 7.5%, and the expectation is that in 24 months you might be able to refinance that to 4%. That investor, that's not a good proposition for that investor, because they've done the math and they know how long that security has to exist for them to make a profit on it. And if the potential for you to refinance that mortgage before they reach their goal exists, they don't want anything to do with it. So it's that spread, and typically the spread between the 10-year and the mortgage-backed security market is about 170 basis points, and it's well over that now, and it's because of that refinance risk.
So over about 2% difference now.
Yeah, yeah, yep. It's well above the historical norm.
And that's MBB, the ETF that kind of represents that tranche of mortgage-backed securities, that's being sold right now. It's one of the worst performers I've seen at a negative 0.31 money flow score. That we would consider very bearish on a six level rating. We use something similar to Chaikin. There's, very bullish, neutral plus, neutral minus, bearish, and very bearish. This would be in the very bearish camp. Yeah. And it's about as bad as the aggregate bond market and the basically corporate bonds and long-term U.S. treasuries are all horrible, but that's probably the worst. There's nothing worse than mortgage-backed securities. I guess the one other thing that's getting sold a ton of is the 1 to 3 year Treasury note ETF, SHY. That one actually has pretty good relative strength, but not very good money flow. So that portends kind of that we're not done going up on short-term interest rates anytime soon.
Yeah, interesting. Well, with that, Mike, you want to wrap up the macro monkeys part of this broadcast, and we'll move on to cheatsheets.substack.com and the relative work that you've done there. And if Macro Monkeys listeners want to continue watching this video, or listening to this visually, where do you post this again?
We will. You can get this. This will be available on the Stock Cheat Sheets YouTube channel. It'll be available on the Chaikin Power User Twitter video feed. It will be available, I think, on whatever your website is for Macro Monkeys. Yeah. And I'm sorry, I don't know the domain name for that.
Yeah, it's I actually don't have the website up yet, but you can find it on stockcheatsheets.substack.com or at chaikinpoweruser.com if you'd like to rejoin the conversation as we move more into the visual components. But thanks for listening to the Macro Monkeys podcast. Please rate, subscribe, do all those fun things, and we'll talk to you next week. And Mike and I will continue with the visual portion.
Yeah, and we'll keep going. Once again, just returning back to our commodity relative strength cheat sheet, where we talked about energy, but I think the other theme out here is that, and again, it's kind of a spotty one. It's not going to apply to everything, but I got a feeling that we're not done with the food inflation story either. So I think that's another sort of elephant in the room besides the creeping energy prices that we're going to see this winter. When you see the fixed products that go into mass-produced food, which is how we feed the world, right? Let's make no mistake. It's the leading cause of diabetes and obesity and likely shorter lifespans through cancer. It's terrible for you. But the fact is that harvested sugar is starting to move in price. And it's not just relative strength. For those of you watching, you'll see that we've rotated from a low 70 days ago of 15th ranked to pretty consistent single digits since then. Our short-term trend, the 5 over the 20-day moving average, has also converted into an intermediate trend where the 10 is over the 40-day exponential moving average. Money flow is still neutral, but that is a pretty typical profile AA for other foodstuffs, like corn would be another example. I'm not going to go through the corn numbers. They look very similar to crude. And then, although I don't think I have it here, soybeans, there they are. Soybeans having a little bit less, probably less success right now, short term, compared to those other two foodstuffs. But we also have, so in addition to, so besides that and energy, we've got the base metal story. It's not going to be everything, but there's platinum averaging 6th rank in terms of the commodities over the last 3 to 6 months. It's a little softer lately as demand may be starting to slow down. But I think that commodity inflation, if it is truly a bellwether of demand destruction, I would say that the non-core parts of inflation are still very much in play. And I'm not sure how much control the Fed is going to have off of those. And high prices may be something we live with for quite some time.
I think your point about food was spot on. I don't know if you noticed this in the latest CPI, but food was one of the driving components, is 0.8 month over month. And housing was also another driving component. But I think you're spot on with food. And to your point, what can the Fed do about it? Jerome Powell himself has said that his tools, the tools the Fed has available, are ineffective against food inflation.
That's right. That's right. He can't, and he also can't control how what Russia's next move is in this Ukraine war.
Yeah.
And that's a whole nother topic, probably for a different podcast. But obviously, if this war in Eastern Europe escalates materially, that's going to affect everybody, from the price you pay for food at the table to the your investment portfolio's performance in the intermediate to long term. So fingers crossed, nothing like that happens. As we move into now the relative strength look at the broader equity market, what I've done here, and this you should have your visuals up if you're going to watch the rest of this, as we look at the consolidated major global indexes, the top sectors and subsectors in the U.S., we see just a few things that are rotating into favor. Don't yet have a trend, right? And it's important to point out that as you look at this, the only things that are in any kind of bullish trend are the energy-related ETFs, which we talked about. But we're starting to see, again, the XME slowly rotating into favor. So another story about base metals, things you pull out of the ground that you need to get an industrial edge, and this is what a lot of the geopolitics are about. We've seen a big rotation from like 36th, 90 trading days ago to 6th on XME. No trends to speak of yet. Money flow just meh, but this would definitely be on my watch list. That probably basic materials as well, which isn't quite as dramatic. AA. And then the other one, I wanted to ask you about this one, regional and money center banks. We had some, I would say the banking CEOs have been the most outspoken in terms of how bad things are going to get. Yet they're doing really well, or at least JP Morgan did really well. I'm not sure if Morgan Stanley did as well.
I think they did.
But the banking revenues weren't horrible, and we see top 10 relative strength ranks and fairly persistent ones for the last several months. Again, no money flow, no trends yet, and I can tell you my investments in KRE and XLF have not paid off at all, and I've backed off of those investments. But they're definitely lurking out there as potential. If the market is going to go up, this will be one of the areas I think that explodes to the upside.
Here's all I know about the banks, especially the money center banks, is that they're sitting on a metric ton of cash. That's all I know.
And they're not willing to lend it out at rates like they used to.
Right.
Yep. So then the other one, which probably no big surprise, is we may be very early on this one, but I'd watch it again, is going to be the aerospace and defense XAR. Again, really horrible relative strength scores. We have had one good 10-day look back period. Otherwise, there's nothing to hold the hat onto. But the reason I bring this up is because the West is pretty much out of inventory to help Ukraine and no end in sight to that war. So I think the Raytheons and Northrop Grummons of the world are going to have a field day, and potentially for years. And if there is a triggering point for the beginning of that to happen, it's probably this 10-day look back period. So again, not acting on this, but I'm just making note of it because there is a fundamental story behind it.
Okay, makes sense.
And then when it gets to bearish stuff, telecom. That's really interesting to me because that one doesn't make a whole lot of sense, at least the way we used to define telecom. But telecom is as much about media stocks these days as not Google and Facebook, not at least for this ETF, but the cable. I think this kind of represents a big secular change in the way people are subscribing to content, because the media companies that have hard wires into homes not doing so well, and of course people have detethered their landlines. So there's what, mobile telephony? That's about all that's left. But this is a sector that looks like it's rolling over big time. Yeah.
And again, that could also be a victim of higher interest rates, right? As telecom's is a yield play, and compared to interest rates, not as attractive anymore.
Very good point. Now I'm going to skip to a couple of ETFs that have nothing going on for them relative strength wise. But the question is, why are institutions probably on down days? They're probably picking up some shares here, just doing a long run investment. But notice innovative tech has just horrific relative strength, horrific trends. But look at that 0.23 money flow score.
That's
curious. It might be worth going and looking at Chaikin Analytics to see if there's a fundamental story behind innovative tech, XITK.
Okay.
And of course, we've got, did I lose my Chaikin here? I might have. Oh, I've got it over here. There we go. So let's look at XITK. And while we're over here, we've also got our ETF stack in Chaikin of all the macroeconomic ETFs that we track. And maybe we can take a look at some fundamentals. So if you were to describe beyond the technicals, AA, what's the one unique selling point of Chaikin that really makes this a good tool to have at your disposal if you can afford it?
Is it the power gauge?
Yeah, the power gauge and the fundamental metrics, essentially, that get rolled up. It's what they call a quantamental system, which kind of sounds like you have a new disability where you can count, but not so well. That's not what it is. It's quantitative fundamentals. So where they take 20 factors and roll them up into essentially a score that has very light on the technicals, the opposite of cheat sheets. Cheat sheets is completely dependent on price action, won't give you any foresight into things the market doesn't know. But here, this does include things that may not be widespread because they track things like insider buying and analyst upgrades. And let's face it, that stuff can be fed by inside information or people who are closer to a particular industry group than the media coverage would warrant. And so we look at changes in the power gauge, changes in the fundamental scores, and why both of us are fans, even post our affiliate relationship. Full disclosure, AA and I get free access to the Chaikin Analytics platform, which is not cheap. One of the reasons I came up with cheat sheets is to solve the problem for lower end investors who don't have trading account or investment account sizes that would justify a $2,000 a year investment. Sometimes you get lucky and get it on sale for $1,700, but that's a big number.
Yeah.
Whereas cheat sheets is $5 a month or free for most of it. So that's why we're in the space we're in, but we don't cover what Chaikin does. And that's really important. And even though AA and I no longer earn any commissions from sales through our various websites, we still are big believers in the Chaikin tool, and we happily agree to endorse it in exchange for free access.
Absolutely.
But what are you seeing on the XITK other than a money flow buildup? Not much else.
Not much else is right.
But the money flow persistency is something that I find it hard to be ignored, as it kind of hangs in there, and it has since May at this $100 level. Almost, it did break down recently, but it's almost like a basing pattern.
Yeah, I'm not liking, so the oscillator here failing to breach 70 in a few months now is a little concerning that it can't turn the momentum around.
Yeah, there's nothing positive about the stock. In fact, it's very bearish. But it is interesting that it just seems that institutions may be nibbling along the bottom here.
Yeah.
Yep. Nothing to get into, or I would trade at the moment, but I always like to know. So on the left-hand side, we've got our list of macroeconomic ETFs, and most of them don't have power gauge scores. ILF we've talked about. That's mostly a technical rating. That's mostly Petrobras fueling that. You can see there's only a few stocks that are getting covered here. So it'll go like energy goes. Mm-hmm. And then we just don't have any bullish stocks besides that, right, in our macro look. I wanted to mention dry ships, because we are seeing money flow in dry ships. But AA, I don't think this has anything to do with economic demand. Dry bulk shipping is ever since the two pipelines were hit by a mysterious nation state, we've seen dry bulk shipping rates go up because economic warfare was essentially declared. And I follow Peter Zeihan, who wrote the book, The End of the World is Just the Beginning. And it talks about essentially the collapse of the global economy, where countries could specialize in one thing and export that to enough other places to import materials that they're not capable of natively producing in exchange. And with that going out the window, what happens now is a Russian tanker going to China has about 20,000 nautical miles it needs to navigate. And insurance companies are not underwriting many dry bulk or fuel tanker ships right now. And most countries require, it's a cost of doing business. You must show proof of insurance before you'll be allowed to dock at the port, because ports are very busy places. And generally you're turning your ship over to a pilot and a tugboat that have to kind of bring your ship, the captain of the ship cedes control in many cases for that last mile or two. And so we're seeing artificial supply and demand shift in favor of the dry bulk shippers that are able to get insurance underwriting, which is not everyone. And one of the big reasons we're seeing BDRY go up slightly here in the last few months, you'll notice it kind of ties into the Nord Stream attack right around Labor Day.
Yeah,
is that threat to economic infrastructure. So pipelines and refineries getting blown up, and undersea internet cables, and ships sitting ducks. You could very easily take. All we need is one piracy nation state to take command of a tanker and steal its oil to change the supply and demand equation for a little while on the worldwide oil markets. So it's going to get ugly out there.
That's interesting. Yeah, I hadn't considered that.
So we're pretty bearish on stocks, and I'm trying to find a story that works, and I'm not seeing one anywhere in the fundamental Chaikin metrics. About the only thing I noticed is that when I run screeners, AA, for bullish stocks, or very bullish stocks, meaning stuff that has been sold so aggressively relative, at least to the valuations that are being placed on it, and based on analyst estimates today, is we're just seeing a lot more bullish stocks. I just wanted to show you when I run a basic screen on S&P 500 to very bullish. I used to get maybe, well, I'll be honest with you, something's changed since I ran this screen yesterday.
And just to be clear, that's the only filter you're putting on is just within the S&P 500 bullish.
Yep.
Very bullish.
By the way, this is a big change from yesterday.
Okay. Yeah, because
I probably had double the stocks yesterday. So obviously Friday's down day changed the course. Now we do have 15% of the model goes into fundamentals, but 15% technical, about 85% fundamental. And what seems to have fallen off here is a lot of the energy companies that I was seeing. You're still seeing a few like refiners, PSX, but there were probably double the number of energy companies that were showing bullish ratings.
Can I tell you my observation looking at this list? And I don't know all of these tickers, but every one of these tickers that I am familiar with represent a company that is directly affected and, dare I say, benefiting from inflation. Energy, healthcare, pharma.
It's interesting and true.
They're all there.
Yep, you're right. And of course, there's some big blockbuster drugs in the pipeline that is also helping pharma, but even biotech. I wanted to show you biotech looks like it's ready to reverse course, double A. And biotech is not even the strongest sector within healthcare. Healthcare equipment, healthcare services, and pharma look a lot better. But look at that's Biogen. XIB is biotech. Look at Biogen's numbers, by the way. Big pop. That must they must have had earnings a week ago. What is it? XBI, right?
Yes.
Yeah. So biotech on Chaikin, very bullish. And it doesn't look bullish, right? But if you notice, this is a breakout of diagonal right here. And it's basically a lower high or a double bottom, depending upon your time frame.
It stayed above the 200.
Staying above the 200, right?
Yeah.
So here's your personality change. Here's the first run. Here's the deep correction. But it looks like it's getting set up to do another run here. I wanted to point that out because it's something I'm interested in trading. You also have some fundamental stories behind it. 50 to 12 on the bull bear ratio, which is probably that's got to be the biggest sector we've seen. And we can look at that real quick. That's the nice thing about Chaikin is there's so many tools to be able to compare stocks quickly.
I'll tell you real quick while you're pulling that up. I ran the sector comparison of the S&P's 11 sectors this morning. Only one had a bullish ratio, and that was XLE.
Yep.
Yeah.
And of course, again, things have changed. We have a slightly bullish ratio on XLV. I'm wondering if the number's updated for you as well.
The XLV ratio is 1.1.
Yeah, 1.1. Everything else is underwater.
Right. Yeah.
But it's essentially energy, financials, healthcare, and staples at the top of the stack fundamentally. And the bottom is real estate, tech, basic materials, communications, which is half media stocks, right? Facebook and Google and Apple. So it's about what you'd expect in a bear market. Defensive, and energy is considered, I think, defensive at this point because it's a must-have, not a luxury, right?
It's a weapon. That's what it's become. Yeah.
So knowing that healthcare is outperforming, but fundamentally a little weak, then you skip down a sector, and there's biotech, 50 to 12. Oil exploration and production, 18 to 2. Regional banks, 69 to 3. Money center banks. By the way, this hasn't translated at all into any kind of positive trend, as you'll see as you look at. There's KBE. Looks like it's trying, right? Trying to break through diagonal.
It's trying.
Yeah, and I'm long KRE, much to my regret. But again, it's trying. I might get rewarded for that.
Both trying to poke above the 200-day, which is, it's a start, right?
Yep, it's a start somewhere. But again, overall, just looking at the fundamentals, you'd expect it when and if the market turns around, you'd expect it to start here. And I just would point out that there's more of these showing these positive bull bear ratios. Not that it's any kind of indication of a bull market, but it just represents a better story than a couple of weeks ago.
Yeah. Interesting.
Pharma is another one that's bullish. And there's insurance. Remember I mentioned insurance. I think these guys are getting away with raising rates.
By the way, just to mention real quick, insurance was something in the CPI report that was also up month over month, particularly auto insurance.
Yeah, big time.
Yeah.
Big auto insurance, health insurance. I don't know if you've gotten your October benefits yet. Ours are going up. Our out-of-pocket is going way up. He had to adjust coverage in order to keep our payroll deduction reasonable. We're not a big company like you. You work at a big company, but I'll bet you've got some out-of-pocket increases coming.
Yeah, they told us that there's going to be no cost increase, but they didn't say there'd be any benefit decrease.
That means there'll be a benefit decrease.
Yeah. Yep. Another form of shrinkflation. Yeah.
Yeah, your primary care, maybe you covered 70%. It'll be 65 this year.
Oh, I have no doubt. There's a gotcha in there somewhere.
So one of the best ways I know to look for turnarounds is to do two things: the relative strength analysis on cheat sheets that I took you through, or on Chaikin. It's something that we like to call a personality change. And I'm a big believer in looking for personality changes. I'm going to review when we go to trading signals, how to do it on cheat sheets, but let me show you how to, or AA, and I'll show you how to do it here on Chaikin. And they've got a screener to make it easy, but what we're looking for is stuff that has kind of bottomed out, has sort of run along a bottom for a little while, and is poised from both a fundamental and technical standpoint to move higher. Now it's going to need a market going up. And that's, I think, it's a 50-50 any day. I just have, there's just enough evidence out there for me to think that it is possible that we'll have some kind of bear market rally before Thanksgiving. We'll see. I'm seeing very minor changes, but this is something I haven't run yet. And I'm going to be very interested to see if we end up getting something beyond the 10 to 12 stocks that I've mostly been seeing for this bullish personality change. If we see more like 20 to 25, that is also an indicator of potentially a rally coming, just from my anecdotal experience.
Seasonality also tends to agree with you.
That's right. Yeah. So we're going to look for, and again, this is the personality change metric. The most important thing is that these things have been outperforming while the market's been going down. So you want a low persistency on relative strength. That simply means these things haven't gone gangbusters. They wouldn't have the number 1 or 2 rank on cheat sheets relative strength scores. But if you were to compare 50 ETFs, these would rank in the low 20s, but persistently for the better part of 6 months. So that's what low persistent relative strength means. And they're looking for stuff that fundamentally today rates at least bullish, if not very bullish. We'll keep it to this number for now. And they set as a default because they don't like to trade stocks that are under $10 because they tend to be more volatile. Mm-hmm. And usually they're less covered by analysts. Now, the other thing you can do is you can limit yourself like they do to large caps. So they're looking for turnaround situations that are reliable. The bigger the market cap of the company, the more these types of metrics play because there's more shareholders behind them. Okay. So we'll get results and see if we get anything, first of all. And the answer is that is not a good sign. What's causing it is the lack of persistency in relative strength and the $10 price. So I'm going to change that because we did get through a horrific bear market and we're going through one right now. So I'm going to change that to strong now and not worry about the fact that it might not have outperformed over the past 6 months. That's a high bar in a bear market.
Yeah, it is.
So once we do that, that changes the game a little bit and we get more like 35 stocks. And I could even, change that and kind of dial it in. Well, maybe because I do like outperformance for a few months before price starts to run. So let's change that to 3-month low persistency and see if I can get 10 to 12 stocks in here. Nope, not enough. So the one other thing I'll try is 1 month low persistency. And then if we don't get that, I'll switch it back to high. Yeah, we got nothing on the 1 month. So there's a lot of rotation going on. So this is probably going to represent fuel, financials, and healthcare, right? The big three in terms of inflation, AA.
Yep.
And there it is. The first three are all healthcare related.
Yep.
Fourth, and there's energy. There's consumer discretionary. Mm-hmm. And there's General Mills, consumer staples. I've been trading Kellogg's and finally bailed on it right as it was starting to go up, I think. But I was running out of time in my options. That's why I did.
You got to be disciplined about that.
Yeah, and I do because they'll decay to nothing. And basically, I took $800 and it almost went to zero on the positive underlying, but I made about $600 in option income, so it was only a loss of $200. So it's what I call a good loss.
Yeah.
All right. So if we look at this, and we're going to focus on very bullish stocks. Let's give you an idea. Now, of course, there's some where the bullish turnaround has happened. Clearly, there was some kind of catalyst here. My guess is some kind of drug announcement. I'm not going to go into it, but it looks like there's another bite at the apple going on right now. Here, you just want to be cognizant of earnings. You're going to probably find that earnings for most of these are going to be coming up in the next 2-3 weeks.
Yep.
So one of the things you can do is, if you don't want to go through and analyze the individual names, is maybe you can explain the checklist here.
Checklist is just the system automates the key points to consider when considering a trade, and it actually makes it quite easy. You just look for 6 check marks, green check marks, and you feel better about the bullish entry.
And you can see them on the chart. So the first one is power gauge is very bullish. That's right up here. Mm-hmm. Relative strength versus SPY, that's down here. And yellow means it's outperforming. Green means it's really outperforming. So this would be like getting a top rank on cheat sheets. Then we have, I'm going to come back to our overbought, oversold. This simply means that it's in an industry group that also happens to be in favor with institutions. So it would, again, be BIIB on cheat sheets, you saw how high ranked that was and what the money flow looked like for. I'm sorry, not for BIIB, for biotech.
Yeah.
Well, that's what that means. It's the strong industry group compared to others. And then we have the long-term trend, which is what, AA? It's this one, right?
That's the 200-day Chaikin moving average, which is
double exponential moving average.
double exactly. Thank you.
Yep.
Which is pointing up in just FYI prices above it.
Yep. And there's money flow. We're big believers in money flow. Now they're scaling it different than cheat sheets, so the absolute score is less important. But the one thing Chaikin does a good job of, better than cheat sheets, just because it's too much formula writing for me to do, is persistency. So this one gives you not only the scale of money flow, which is lower than it has been. You can see the peak of accumulation was here around the earnings per share stock announcement in late July. We'll probably have another one here in late October. Yes, we will. October 5th, 25th. And then money flow persistency. So that's the checklist. And then talk about this, since you use this to the bearish side, but what are we looking for here?
Basically, the stock right now is rolling down out of overbought, which ideally, to enter a bullish position, you'd want that to be in oversold. So the other end of the spectrum and rolling up.
Yep.
So
the cheat sheet equivalent to this is buy the dip. So for this is one consolidated oscillator where you're looking for this to be below 30 and curling up, as AA said. On cheat sheets, this would be the equivalent of having the intermediate market forecast line rolling up. So it's bullish. It can be overbought, but the blue line, the near-term line, pulling back to a light volume pullback that's not too hardcore. So this curling up is the Chaikin version of buy the dip. It's going to be a slightly different time frame, but it's the same idea. Stock has lost momentum, but not disastrously so. And we know that because it's curled up before collapsing past a key support level.
Yeah.
So this is the equivalent of buy the dip. There was another one here, and you can see both of them worked out in terms of good entries. The last two, this one wasn't as good. Even though it went up, you had to visit some capital losses first, but that's the idea behind a turnaround time. Now it's cleared this index. It probably is unlikely filling the gap. There's clearly some sort of acquisition or major structural change. It might be that they just did a reverse stock split. I have no idea.
Yeah, no idea what's happening here.
Yeah, we'd have to go look at that, but clearly it had its pullback and then bounced, and then it gave some back on Friday. It actually looks like a pretty decent setup if it weren't for earnings.
Yeah.
And we're going to say that over and over again about earnings, so I'll probably drop that. Let's look at a few and see what you like the best.
Can I just ask, are there any with signals? Maybe
Nothing with signals.
Nothing with signals. Okay.
Nothing with signals. Nothing with signals, which is a great idea. But we can look at these real quick. They're all going to have earnings. We'll pretend they don't. Cardinal Health has been going sideways for a while. Overbought. Cummings. You know what I could do? I could reinterpret this. I'll tell you what. Let me do this. So one of the things we can put on here, if we're looking for a timing, is we can
oversold.
Go down here and look at oversold. Yep.
Which basically will just put that oscillator in the position below 30, which there are none.
Yeah, this is telling you not a good time right now. We can move on. See how easy that is?
Yeah.
Yep. But that's probably a good watch list of stocks right there. Yep.
Yeah.
All right. Some other things that we can do over here in the Chaikin space. That again, I'm just trying to show you the comparable from cheat sheets is the ETF comparison. This gives you the ability to look at things, in the 1, 3, and 6 month return, and you can kind of look at the relative rate of return. You can see for the most part, stocks are losing money. But what you can do is look at what the rank looked like. The strongest stocks 6 months ago to today were energy, healthcare, staples, and industrials. So remember those three. Now, all of them, with the exception of energy, have lost money. So again, with relative strength, it's about least worst, not necessarily what's going up in price. But remember that list: energy, healthcare, staples, and industrials. And then we can take a look at the 3-month report card. And we see energy has been persistent and moved higher. Financials has rotated more into favor. You can see it didn't hold yet, but it's starting to show some positive returns. And there's industrials again. So you're starting to see kind of a theme here. These 4 keep showing up. And then we can look at the last month or so. It's been really rough. It's been rough, but there's energy, healthcare, staples, and financials. So they're roughly all four sharing that upper echelon. And so if the market's going to turn, you'd expect these to do better.
Yeah.
So the other thing we can do is drill down into these by looking at subsectors. And so just keep in the back of your mind, in XLI, we have an aerospace. In the back of your mind, think about, we did biotech, let's do healthcare equipment. In the back of your mind, just think healthcare equipment or pharma. Consumer staples, I'm not sure what to look for in the back of your mind there, but I'd say we'll just look at a consumer staple ETF if there is one. I can't think of a sub ETF, can you?
No.
And for energy, probably oil exploration and production or oil services would be the two places to look. So what we'll do is come down to subsectors and we'll go through the same exercise and see what looked good 6 months ago and what looked good 3 months ago. So nothing looked good, but there's oil exploration and production, only lost 4%. There's regional and money center banks, lost about 5%. And there's insurance, so financials look decent. And there's pharma. And of all things, there's home builder. But again, we're starting to get into double-digit losses 6 months ago.
Yeah.
Okay, so I'll jump ahead and I'm going to do the 1 month performance. And we see, oh, there's insurance again. So I think we definitely want to look at insurance, AA.
Okay.
And banks. And I think we've covered energy enough to where we know that's a great place to be.
Yeah.
I don't know about home builders, not at -20 and -5. And I'm not sure about pharma either. Let me look at the 3 month to see if pharma makes it in the 3 month. We had the 3 month actually has some winners here, but none of them are pharma. There's XME trying to make it back into favor, but again, it collapsed in the 1 month. So I think we stick with what we just talked about.
KIE and KRE.
Yeah, and maybe even though they've fallen out on the 3 month, I think from a look at that. Yeah, the healthcare stuff sort of fallen off here.
Yeah.
Yeah. Okay. Well, we'll take a look. What I don't see is the aerospace. Where is aerospace?
There it is. XAR.
Yeah, no bull bear ratio, nothing going on. Nope. Not ready. So banks, I guess it's banks. So let's go into KRE and see what's available. And then look at that. You get to see, this is not everything that's bullish. It's just what we call the highest market cap things that are bullish, right?
Mm-hmm, mm-hmm.
So is there anything out here in KRE land that you like? I generally think maybe H Bank is something that I trade a lot.
What is that? Huntington Bank shares? Yeah.
And then money center banks, it looks like.
There's HBAN again.
Again. All right, let's look at HBAN. And our earnings are going to be an issue, but earnings are going to be this week, if not next week. So we'll take a look at H Bank. And earnings are coming up this coming Friday. We're in a bit of a consolidation pattern, not a bunch of money flow. The relative strength looks decent. The power gauge has just moved from neutral to bullish. So I think we'll be waiting for a breakout here.
Yeah, dancing around that 200 day.
Yeah, let me get into KBE and see what else is there. It's a neutral plus overall. You can always just trade it. I'm not there yet with this, but I do see a potential personality change coming. We got price getting ready to break out. We've got money flow. We've got relative strength. We just don't have power gauge.
Yeah.
And we got an overbought oscillator. So there's a lot of stocks here. Am I in? I might not be in KBE. Let's look at the list. There we go. So we'll deal with a few of the very bullish. Well, there's a ton of very bullish, aren't there? 39-1.
I still can't quite understand why banks are so bullish, other than that they're just sitting on a ton of cash.
Oh yeah, and they're not that bullish from a chart standpoint.
Yeah, technically they're not. Yeah,
it's very bearish. Yeah. To see if there's anything turning around. We'll just do a sample of it. Here's one that broke out. Earnings coming up in 2 weeks. This is a Valley Peak Valley reversal candidate. I think it's already happened here. Draw the diagonal line. You connect those two touches with this breakout, throwback, retest, bounce. That one is probably swing tradable into earnings over the next 2 weeks, although some would argue you might have missed it. It's a momentum trade at this point. But again, I think swing trading is all I'm willing to do in a market like this.
Yeah.
Here's another one that just broke out. And earnings are Thursday. Money flow is there, relative strength is there, and power gauge is there in a big way. Little bit of an oscillator move. We had, I guess a bit of a slightly higher low, confirmed by the oscillator, but that one is a breakout. That probably was be an after earnings right on a throwback retest potentially. There's another one. Boy, there's a ton of banks breaking out, aren't there?
Yeah.
It looks like banks want to go. I feel better about my naked KRE calls. Here's another one.
Just have to wait for them to get past earnings.
Yep. All right. So what else did we see was earn insurance. Let me just dig that one up.
Was
But
that
it looks
KR?
like banks are in play, doesn't it?
It does.
Yep. And banks have a fundamental story to go along with the technicals. All right. KIE.
Yeah, you didn't grab the list on that one.
Yeah. There we go. I'm a little rusty in my Chaikin. All right. KIE. Trying to do the Valley Peak Valley reversal. I wouldn't call that yet. There. The money flow is not persistent yet.
I see one
This
down
one
there.
has to get through this thing for me to be remotely interested.
Yeah. So say I see one down there with a signal, if you care.
Yeah, let's take a look. Only bullish, not very bullish. Momentum breakout. We hate those.
Yeah.
Momentum breakouts are prices that move here. They've left us mostly destroyed. But definitely a breakout of diagonal resistance here. Let's see if we can find something very bullish. Is there anything you recognize as a name? I recognize that, UNM. Unum Insurance. That one has broken out. Again, all these guys have earnings right around the same time.
Yeah, that's not a bad looking trend.
Yep. You're in good hands, Allstate. Trying to, nice little turnaround pattern here. Complex head and shoulders reversal, right?
Yeah, I see it.
There it is. Trying very hard to get out. Going to have to deal. You've ever noticed head and shoulders always happen around earnings? Usually
I hadn't noticed that. No.
Yeah, I just tend to, you think, oh, let me get in here. Earnings in 20 days. Harder to trade those because they take a while to play out. Another head and shoulders setup here. So it's amazing when you do see the ETF poised to go big, you'll see a ton of technical setups that all support that idea, and always reminds me better to wait for a few breakouts before I jump in.
Got it.
All right. And then was there anything else? There was some healthcare, but we didn't see it, I'd say, definitively on the Chaikin. I just happened to see it on.
XPH was a subsector, I think, that we.
Yeah, let's look at Pharma. Agreed. So a lot of big blockbuster drugs that have come out. There's obesity drugs that have cut people's body weight 20%. There's an Alzheimer's drug. There's new diabetes treatments. It's really been an explosion after 10 years of stagnation. Pharma and biotech all sort of enjoying a renaissance here. Now, oops, that's KIE. PPH, right?
XPH.
Same thing.
Oh, okay.
PPH is a little bit more liquid. So PPH looks terrible, but this is a possible double bottom. Now, this becomes more of a double bottom, double A, if we see this oscillator curl here.
Yeah.
Then we'll like the divergence. So we're looking for a higher low in oscillator to go along with this similar low here. We need the curl to happen immediately and a breakout of this double bottom. That's a trend reversal pattern. It could be in a bear market rally and get us up to $70 and we'd still be in a bear market rally.
Yep.
Not a bad way to live. 68 to 74, I guess.
Nice little swing trade if it happens.
Yep. So relative strength is trying. Money flow is trying. I'd say we're a long way away from being healthy overall on this, but let's look at a few very bullish stocks. And I'm going to have to do this one more time.
Yeah.
I'm going to have to do the stack. And so there's the stack. And there's only one, so it makes it easy. It's Merck. Yeah. There's a few neutral pluses, which means the stocks look bullish, but they're below their 200-day moving average. They're Chaikin trend. So here's Merck. That one looks good. There's your diagonal breakout. There's your oscillator. Similar low, higher low. Kind of a tough oscillator, but it's definitely a divergence, double A.
There's something that I've began to use over the last couple of months that I wish was visualized here, and that's volume. And I know money flow is kind of a proxy, but I wish there was a volume.
Yep, agreed. You'd like to see, especially on the day that you're tracking a breakout, which would be here.
Yeah.
You'd like to see a high volume move.
Exactly.
I guess you got it in the form of the power gauge changing, but not really. That's just simply the stock moved from under the neutral plus to very bullish. All right, I'll do a few of these. And this will be the kind of the last thing I think we do.
Okay. I do have despite it being.
Oh, we'll do your short trade.
I have one bearish setup that I found interesting this morning.
Okay, we'll take a look at that. All right, so AbbVie, again, check the earnings first. Nice support area at 130. Doesn't look like it wants to go much below that, but maybe wait for earnings. ABC, another potential double bottom setting up. Long way to go, and don't have the money flow. Bristol Myers, no money flow. This one I don't like because of the lack of money flow.
Yeah, they are all pretty
Yep,
consistently
it
bad.
doesn't look like support's going to hold.
Yep.
And there's a case of support not holding. So it might not be Pharma's time. There's a, well, this is interesting. We've got a, I guess it'll depend on what happens here. You don't normally see this kind of, this is a lower low and a low here. We'd be looking for maybe a higher low. We're getting a higher low in price. I wouldn't touch this with a 10-foot pole.
I wouldn't either.
J&J, definitely some support down in this area. Some money flow. The oscillator's curling. Earnings are Tuesday.
Yeah.
So this might set us off in a new direction. We'll see. All right, one more.
Sure.
And we'll do your short trade and we'll call it a week.
All right.
There's Merck. This isn't Merck. I'm sorry. This is McKesson.
McKesson. I've never heard of McKesson.
Healthcare provider. They do a lot of telemedicine, I think.
Okay.
All right, there you go. That one looked pretty good. That would be almost what we call a classic bull going through a bit of a consolidation period, but earnings are going to be in the way. So we're trading ETFs right now during earnings. All right, AA. First, should we do your screener to see if there's anything more?
Sure.
All right. While I pull this up, talk to me about your screener.
Basically, and we've talked about this many times, the trigger to the screener is relative strength versus the SPY turning weak this week.
Yeah,
right.
There's 32 of them. It's a big week for it.
And I went through them, most of them today. Earnings are a problem. There's one that I found. If you just want to go to CRWD.
All right, crowdsource.
Yeah, and it's technology. And keep in mind.
Oops, I missed it. CRWD. I'll just get it from you.
Yeah. Keep in mind that the XLK just does not look bullish at all.
No, in fact, I'm very short the Qs.
Yeah. So this was pretty decent because earnings are out. You can get into the next expiration cycle.
It says here earnings are December 1st. Do you think that's a misprint?
Oh, I don't know. I just know that you could sell November.
Oh, earnings are out, meaning it's so far away in the future. I thought you meant earnings were out.
I'm sorry. Yeah.
No, it makes sense. I didn't listen properly. I get what you're saying. They're out of the picture.
Yeah.
Yep. Far enough down into the future and definitely not being helped. The trend is negative.
Downtrend, unable to hold the 200-day, negative money flow. The oscillator hasn't been able to breach 70. Relative strength turned weak again this week.
Yep.
Very bearish, weak industry, weak trend. Just look like a decent setup.
Getting close to not actually that close, but this might dictate the type of trade you would do. I would assume that you're probably less likely to do a naked put down here. My guess would be you do a put spread where perhaps the short put is down here around 135, 140, something like that. Yeah,
actually, absolutely. I think my preferred personal way to play this would be a put diagonal.
Right. Okay. So long. That's basically what it's saying. Not a vertical. Okay. It was a so you buy the January and sell the November. I think there's still enough time left in November.
I think there's still. I think you're absolutely right.
Yeah. Let's try that. Let's take a look, and then I'll do a call spread. Have you checked for liquidity on this?
Yeah.
Okay. So it's liquid enough to do options.
Yeah. I looked at it Friday when the market was open, and so during market hours there was liquidity. I don't know what it's going to look like.
So we do need to explain that market makers have been widening out their bid-ask spreads after hours. Just know you'll want to verify this, that we're no more than 10% of the strike width. And frankly, I like 5%, but sometimes you have to live with 10%, especially for more expensive stock. As long as you're, and this one is nicely liquid here after hours, just looking at it here. So what AA is going to do is he's going to buy something that's kind of like the equivalent of a stock that he would sell short, right? And are you a 70 delta type person, or do you cheat down to the 60?
I cheat down and 60 or even at the money, depending.
Okay. So again, double A is,
and that's a little
like
aggressive. I admit that. That's a little aggressive.
All right. So we'll do a 60, knowing that I tend to like the 70, where you get the best of both worlds. You get a fairly cheap price, but where theta decay, it doesn't outweigh your short, the benefits of positive theta on the short strike. You want the trade to be, I think what you're saying is you cheat, but try to maintain you still want net theta decay on your trade, right? So you're not paying theta.
Correct. Right.
Yeah.
And
Right.
for me, a personal choice, my trade-off is I'd rather go out. So if I'm going to pay the extra premium to be deeper in the money, I'd rather go out to February or March and I'd still be aggressive and not be as far in the money and just have more time and pay the same cost.
Got it. All right. So I'll do the 60 delta at 165 to start with. So what double A is going to do is buy a put diagonal that his long put will move 60 cents for every dollar down the stock moves. So it's not quite as good as holding long stock, but it's better, right? I guess that'd be the operative word. And then you're short November.
Yep.
And so what he's going to do is sell where he doesn't think the stock is going to get to, or if it does, he'll be able to roll in time. So what he's going to do is sell somebody else the right to put the stock to him at 135, meaning that's going to be his risk control, or meaning it'll cut the amount he can make off the trade, but in exchange for that, a low probability of getting there, right? There's probably a twice as better odds that it doesn't get there than it does. So about a 30% chance that stock makes it down to that level, but he gets paid for selling that option. He gets paid, what, about $600 here?
Yeah.
Yep. So what am I doing? I don't need to do this. I'm going to sell the 135 in November. So I bought the 165 put, and I'm going to sell the 135.
There it is.
And that's still a net debit for him because, there's some expense on the 60 delta. So he's paying, he would be paying otherwise about $2,900. But he's only paying about $2,200 because maybe a little bit more than that, because he's getting a credit in exchange for giving up downside. Remember, this is a downside trade.
Right.
So he's essentially short. He's going to have to pay $2,200, which is probably, this is my guess, is you cheat the delta down. Will you do a cost basis that high, or do you actually like it under 1,000 or under 1,500?
I would probably cheat it down to a lower cost myself. And again, I fully admit that's aggressive and probably doesn't work for most people.
Right. He's just trying to do it based on the size of his account and the risk he's willing to take. So we'll call this as a sort of a happy medium here. And so what he's going to get is hopefully slightly better than 50-50 odds, which they should be, in exchange for some upside. And so the nice thing is you're already in the money on the trade because of the credit. And obviously because his in the money January option is a little bit closer to at the money, there's a little bit of a decay in this, right? If we were at 70 delta, it'd be more like this. But that's okay. He's pretty much banking on the idea of the stock not getting much lower than here, right?
Right.
Because he wants to get paid. He wants to get paid by somebody else who's willing to bet that the stock will start accumulating value for them once they hit below 135. So there's somebody out there willing to make that bet, but not double A. He's going to get paid for this portion of the downside plus the credit. Or another way to look at it is you're lowering your cost basis.
Exactly. Yeah.
I like to look at it as you're paying $2,900, but you're willing to get paid $600 to give up your gain below 135.
And the probability is there.
Yeah, and he's got actually a pretty good chance of that happening. So overall, the first thing that I'd point out is this is a great, whenever you can do a long put diagonal and have a 60, it's not going to be that good. But my guess is it's going to be way better than 50%. Let's see what look at that, 60. So his odds are better than 6 and 10 that he doesn't lose any money on this trade. Now, remember, he can also hold this trade through January if he wanted to. So if, let's say, price gets down to here, but doesn't get all the way down to here, double A could roll this option, which will decay faster than this option, he could potentially get another credit in December. So this upside doesn't include the potential for additional income off of the short strike that he's selling.
Right.
And that's why I like these trades.
I like this trade too. And
Yep.
that additional income is just further cost basis reduction.
That's right. Or another way to look at it is further yield off of the money you've already laid out. Either way, I like it because it feels like as a covered call trader, you're making 30%.
Yeah.
A month. All right. So that's his, these are his odds. Now, what about his return on risk? We want to check that. Now, for a put diagonal, very rarely do we get paid the same or better as the risk we take. But if we can get close, remember there's additional rolls that make this gravy. So AA's downside is the cost of the trade, essentially. So he can lose $2,200 and $22.23, right? That's what you lose.
That's the max loss. If it went against me and I froze and I did nothing, that's the max I could lose.
Yep. And the most he could make would be at expiration. We don't make it to this level. He can make potentially, let's call it 1137.
Okay.
So we'll take 1137, your return, divided by, what was it, 22.23?
Yep. 51.
So he gets paid a 51% return on 38% risk. And that's the benefit of trading with a high VIX. Now, one other thing, he is still not paying the market maker time decay. He has got a positive theta trade by $6.97 a day. So what that means is that his in the money option is doesn't have that much extrinsic value. And what it does have, he is able to pay for by selling an option to somebody else that more than accounts for the time decay on his long option. Because remember, options always have a depreciating part. It's the value of the option itself in terms of the actual value at expiration, plus whatever premium you're paying or getting paid at the time you make the trade. And in AA's case, there was about $600 in extrinsic value that would decay off the 135 option. That will more than pay for the rate of decay on his in the money January option. So in effect, this is not only a something that can appreciate in price, but also has the ability to make a little bit of money on theta decay. So this is that line here. And it means that if AA were to, let's suppose the stock were to crater tomorrow and get down to 135, there's a lot of reasons for AA to stay in the trade. Not the least of which is this.
Right, because that
all
time
of this
hasn't
decay that it can make.
That time hasn't melted yet.
Yep. So this is a very high implied volatility. I got to be honest with you. We don't normally see 38% risk against a 51% return on risk. So this is very good. And I would caution that part of this is due to the spread after hours, but not much of it. But there'll be a little of this. My guess is this risk would come in a little bit.
Yeah, give a little bit back in an open market. But I mean, honestly, this is a better trade than I thought it was when I found it. Honestly.
Yeah, that's why I want to verify it while it's closed, but it looks great. Yeah. And so here's the other way to trade it. This is the Mike, more conservative method. And so what I want to do is give the stock, I want to give myself room to be wrong. So what I'm going to do is trade I'm going to trade a $10 wide vertical call spread. Let me show you how this works. Again, it's another positive theta trade where I'm going to get paid as long as the stock stays below my strike price of 170. Remember, the stock is at 145. So I have a $25 head start. And I'm going to get paid something for selling somebody the right to take stock I don't own from me at 170, right? Which means I got to go out to the market and get the stock for them. It'll be called away from me if the stock is above 170 between now and expiration. Okay, so that's my risk. And so that is a risk, and stock prices can go up to infinity. So what you want to do is protect yourself. And so what I'm going to be doing is saying, listen, if this trade goes against me, I'm going to cover the first $10. But once the stock gets above 180, I want somebody else to take over the potential downside of being short. I'm essentially short the stock at 170, but I'm again long the stock at 180. So that'd be like me buying shorting a stock at 170, but then buying a stock long at 180. This is the equivalent.
You've defined your risk at the spread, which is $10.
Correct. But I get a net credit, meaning this is money that goes into my pocket today and stays there pretty much forever. Now, there is the chance that I have to go out and cover losses here. Okay. But that's not with this credit. It's not like this credit gets taken from my account. I would have to go cover my losses on the trade, but this is money I get today for taking the trade. And remember, I have a $25 head start. So in addition to that $25 cushion, I actually add $3 to that cushion because now my break even moves from 170. Remember, this is the strike price that I start losing money at, but I've added a $3 credit. This is per share, and there's 100 shares in every option contract. So hence 300. So my break even is 173.05, right? So a little bit better. I've got a $28 head start. That's the way I like to look at it. So in terms of what that looks like out in the playing field, I'll shut off AA's trade. Mine's going to look a lot different than his. It's going to be higher probability, but not as rewarding. But that's the trade-off, right? For a little bit more peace of mind.
It's also going to be less capital intensive.
Less capital intensive because I'm not having to pay for an option. My money will get tied up, but only about half of my money compared to AA, who will, depending upon the type of account he's got, half to all. I'll be more like a third, 25%. All right. So according to this, I have an 80% chance of breaking even, meaning I'll lose a penny or more at the 173.0. It's calling it 03. This is probably because of a fee. There's probably a 2-cent option fee of some kind, but that's my break even. So I have an 81% chance of making a penny or more between now and expiration. Remember, I got a $28 head start. So I would have to lose, the price would have to come down to 167-ish. So put that in perspective. Now we are in a downtrend. So not come down. Did I just sell the wrong thing?
No,
I sold the right thing.
Yeah, you did.
Hey, what I meant to say was it would have to come up to 167, not down. All right. So where is 167? Well, that's nicely up here. It's kind of inside this line of congestion right here. Okay. Mm-hmm. So the stock is already kind of moving in the direction I want it to go. Closed near its lows. It's been in a downtrend. We do have some major support here. There's always a chance that this is the reversal zone. That's the risk, but I got some wiggle room here. Okay. So this trade sets up this way. 81% chance of making a penny or more expiration. So I don't actually make my full return until I cover some of that, cover this. But for argument's sake, let's call it an 81% chance of profit versus a return on risk. That is, AA's will be writing shotgun on the calculator. $305 reward against $695 in risk.
44.
So actually not quite as good a payout as AA, but a slightly better probability of profit.
Better probabilities, and again, less capital requirement.
Yeah, less capital requirement, and but both trades are. This one is extremely theta positive. So this one will actually. You know what? Yours is more theta positive than mine.
Huh?
Isn't that interesting?
That's very interesting. That's very uncommon.
You know what? It's because the put spread on a high VIX pays a lot better. It just means your out of the money put is more valuable than my out of the money call.
That's true.
Yeah,
that makes sense. Yeah.
Yeah.
Don't see that very often though.
Yeah, less theta decay. And I could probably get a little closer to the money and get a little bit better theta decay, but this is good enough for me.
Yeah.
So either way is a winner. And of course, we both would have exits. My exit would be if I were to lose this $300 credit, and then so basically if I lose the initial money that I collect, and then I lose its equivalent. So essentially 2 times the credit I received, meaning my potential loss is 1 times what I'm willing to make on the trade, right?
Right.
So I would lose my credit and then lose the equivalent of that credit. So it's a 1-to-1 reward to risk ratio. And the reason I need to do it that way is because these things can lose a lot more than they make on a percentage basis. And if I let this go to expiration, I'd have to have 3 winners in a row to make up for 1 loser. right? Because I'd lose my original credit, and then I'd lose twice that credit again.
Having those controls let you stay in the game and create more occurrences with the probabilities in your favor, et cetera, yada, yada, yada.
Yep. So if I lose one for every one I risk, and I have a 70% chance of winning, it means that I'm going to be profitable.
Yeah.
Right. Just have to trade enough times. Now, AA's model is going to be a little different because his is going to wildly fluctuate depending upon the VIX. But so he's going to be probably more tactical and less systemic about his put spread trades, the way I am with my call spread trades. But he ends up not having to make as many to cover losses.
Because the winners win more.
Right.
Yeah.
When we win a bigger percentage gain.
Yeah.
Yep. And so you have to, but he has to exit. And so that's why I'm curious what you give yourself. Are you a technical exiter, or do you say once you've lost half of the value of your underlying put, or maybe it's half the value of the lower cost basis put spread?
So what I do, and it may be a little unconventional, Mike, but what I do is I'll identify a technical position, and then I'll give myself X% below said technical position, and
or
that's
above.
and that's my exit.
Yep. So a lot of people do that, and I actually have that set up here. This is called a Keltner channel. This is the 21-day moving average, and my line in the sand, if I were to short this stock, would probably be 201. Maybe that might be a little much in a bear market. I'm sorry, it's not going to be 201. It's going to be daily charts here. It's going to be 175. So that's a $30 move. I probably wouldn't do that either, but you get the idea. I would choose some multiple of an average true range here. Right now, I've got the average true range set to 2.1 time. Red is 2.1 times the average true range. I'd probably cut that in half, and I'd probably be here. So somewhere around 165 would be my exit.
Does the ATR account for current volatility?
It does.
Okay, good.
But the ATR is essentially volatility, right? Because every day's average true range is going to be different. Right now, I've got this set up as a 21-day moving average of the implied of the average true range.
Okay.
So a lot of traders, what they'll do is make it 5 days, 5-day average of ATR. Others will take the ATR from the most recent resistance, which you could argue is here. So you might tack on 1 ATR or 2 ATR right from the pivot point. Depends on, everyone has a different system. The bottom line is you do have to give the stock a little wiggle room.
And that's kind of what the point I was trying to get at is that in the current volatility environment, you have to give it a little wiggle room because bigger moves are expected. You don't want to get whipsawed.
Interestingly, what I do is set a 50% walk away move in general for all my option trades.
Got it.
And then give myself the chance to make 50% gain. Although for long put spreads, you have to, because your risk is greater, most of the time you have to give yourself more reward. Yeah. So I give myself 1.6 times risk as my get out point to the upside, and 0.5% risk to the downside.
I do think it's interesting. It's important, I think, to kind of craft your entry and exit to the market environment. So the fact that volatility is hung in at 30 and it's not at 10 like it was, 3 years ago, you kind of have to change things up to match that a little bit.
You do have to give your stock an opportunity to move.
Yeah.
Yep. Well, it's been a good meeting, our weekly meeting. We didn't really discuss market direction. Maybe we should just end up with that. We sort of implied that it doesn't look great out there, but we have been in this situation before where if you look at the weekly candles, one of the nice things about trading bearishly against a long portfolio that you don't touch or don't touch too much is that the markets never go down in a straight line, and you have a lot of different opportunities to sell short. It doesn't go down in a straight line. So you end up making more income. You don't make more income than you lose by staying fully invested, but you can make a lot more than you think you would compared to a market crash. Now, I think we're getting ready for a market crash, but I'm just not sure if it's going to come before a market reversal first.
You have a similar opinion to me. I think we could actually get through the rest of the year honestly, with elections and then Santa Claus and all these things. I think we can get through the rest of the year before we really see a downside.
Yeah, we're going to go sideways, maybe a little bit further down. Maybe after election, there'll be a little bit of a move down, but I think there's going to be a Santa Claus rally in here.
Yeah.
At some point.
And the key will be, is it watch the high back in August, and I would expect the lower high, but that'll be what we're watching for, right?
Yep. Yeah, I mean, right now, this is our, I'm going to actually, let me move this to 3-year. And I think the NASDAQ is a little bit more bearish.
Yes,
I'll change this to, whoops.
The NASDAQ is a little more bearish and the Russell is a little more bullish.
Yeah. Yeah. Now we still have this megaphone pattern, which I think ultimately is going to be, we're going to hit this downside on the megaphone. I mean, I hate to say it, but we're going to be in the 2000s before this is over, in my opinion.
I like I'm looking at that 3,200 level that you have highlighted there with your.
I think that, and again, I'm less optimistic about that level being the stopping point, but probably a pretty good price target.
Yeah.
And of course, when you look at this, it looks like the path of least resistance is lower. And when we take this, we've just had these weird anomalous catcher's mitts, so to speak, because this normally doesn't happen, right?
Yeah.
We break and then we get these moves. There's nothing bullish going on, but someone is keeping the market from collapsing. I think that ends on November 8th.
The other thing, and I've said this for years with you, meeting with you, is when they lose control, whoever they are, when they lose control, it is going to be disastrous. Yeah. And at some point they will. And hopefully I'm not alive to see it, but at some point they will. Yeah.
Well, let's talk December 2018, for example.
Yeah.
That was a horrific month in the market. So it looks like, I mean, if one considers this truly a line in the sand, and you could argue about the touches, but I think this is a pretty good longer term area of support. And we've had it with kind of neutral money flow, but there is, I think, a Fibonacci extension we could draw to get a decent downside price target. Now, with that said, I think we'd reverse off it quickly, but let's just try it. Let's see, I'm trying to studies. Here we go. Why am I having that's not studies I want. It's drawings. Yeah,
drawings.
There we go.
Remember that December 2018 photo of Mnuchin on the phone?
Yes.
Yes.
Yeah. So I'm going to actually take us from the top here. Oops, let me go the other way. So I'm going to take us from the bottom, and I'm going to use this as the bottom here and to the top. So I think a minor move that could happen where the plunge protection team comes back in, or whatever the fuck they're called. I think this price target is very likely.
Yeah.
And then when we start to get serious, we're going to hit our COVID lows.
I ultimately agree with that.
So the question I have is, do we come down, and is there a new diagonal trend line here? And are we going to reverse off of it and then head lower? That's the question. It sure doesn't look like it, but again, we keep getting these long tails. And at some point, remember, this is a weekly candle here. So buyers do come in, and
we're on the bottom side of that fib line now, though, which is new. That's a new development.
Yeah. Now I chose to draw that line there, but I even gave it a little bit more than it deserved, in my opinion. Touch here. I split the baby, in other words. This looks like a throwback retest fail to me.
And that's my point, is rather than looking down at support, now we're looking up at it.
Right. At resistance. Old support has new resistance. Yeah. Yep. And we have money flow in our favor. We have relative strength now. Now I'm talking about versus the IWV. The IWM actually looks a little stronger.
That's what I was saying. The NASDAQ looks more bearish. The Russell looks more bullish. Mm-hmm.
Yeah, well, the Russell just looks more neutral, I guess, is the best way of describing it. But there's no question there's more Russell stocks out there that have bullish ratings right now. And SPX is somewhere in the middle, closer to what the NASDAQ looks like. But again, the other thing you can look at over here, and this is where I'll close with cheat sheets, because I'm going to show this to here and then on cheat sheets, and then we're going to go.
Okay.
But to the bullish side, when we had that one-day reversal, we did see the momentum line get above 90. Okay.
Mm-hmm.
Now that is a very important measurement, and while we haven't gotten the near-term line to follow through above 80. If that happens, and that's enough to pull the green line above 20, that would be called an intermediate trend progression signal. It's the weakest trending signal we have. It requires the blue line to get above 80 on the day that the green line gets above 20. So we have that cluster. Remember, all three the two junior time frames and the intermediate time frame are here. We did have the move above 90. We would need this move above 90, above 80, and we need this to get above 20. If that happens, there's a chance we have a tepid trend. But remember, this thing, after getting finally pulled up, it took 2 months of rally, right? This is our summer rally that finally moved the long-term sentiment line back up to the north side, but it failed at around 50 and we're heading lower. Any move we get to the upside is going to be tempered by this. Mm-hmm. And as of right now, the two senior time frames are both bearish. Remember, a green line can move in any direction, but when it's below 20, it's considered very bearish. So that's our intermediate time frame. This is our long-term or market sentiment time frame. This is what we call neutral. This is called bearish, not very bearish. It's below 50 and pointing lower. So when you have these two time frames in agreement, generally speaking, if the junior time frames confirm, and that would be a move on the near-term line to below 20, which happened, right? And the red line below 5. When if that happens again, that pretty much guarantees a lookout below. On the contrary, if we get these two junior time frames enough to change the trajectory so that the green line and the mustard line are no longer shaking hands, they're no longer both bearish, then maybe we see a tepid move to the upside. The odds favor the first scenario more because we're already there, right? With these two lines, a lot has to happen. So how we close the next couple of days, I think, are going to determine whether or not we get that Christmas rally.
Agreed.
So over on cheat sheets to close things out, and you have this in your inbox for those of you who subscribed. And if you haven't, you can go to the blog, and this is free. This is not for paid subscribers. You can go to stockcheatsheets.substack.com and get this right now. It's my integrated look, and I just have to find it here on my raw cheat sheets. And let me do it on the major indexes because I know it's here. So we take a look at, let's look at SPY. Oops, this is relative strength. I apologize. Over here to trading signals. There we go. All right. So we'll go down to SPY. So remember, if you don't want to screw with any of this, when you have a tailwind score below 50, you stay out of the market because it's going lower, or it's been lower and you wait for reversal. But at 13 overall represents horrible trend, horrible long-term, intermediate, and short-term trend. These are all 10 weekday or hour moving averages above or below 40 weekday or hour moving averages. The trend of the market is lower in multiple time frames. No questions about it. Buying pressure. We are under liquidation right now. Bearish means the Chaikin money flow overall is below negative 0.1. That's bearish. Now, this is our benchmark, but quite honestly, AA, it's not really our benchmark. Our benchmark is the IWV. So this is unfairly being blocked. It would actually have scores that would add to its cheat sheet score normally, but we're just not seeing it. Okay. So here's the two senior time frames. Factors 7 and 8 determine the trend. And right now, both are in agreement. And when they're in agreement, there's a much better chance the trend continues we're already in a downtrend. The forecast in the weeks to a couple of months and the couple of months to maybe a year or two are solidly bearish, below 50 and pointing lower, both of them. Okay. So right now, the two junior time frames are neutral. And that is, we're kind of in the 20 to 90 zone here on the near term line, and the 20 to 80 zone in the near term line, and the 10 to 90 zone of momentum. We get a pop above 90 and above 80, or a move below 20 and below 10, and especially below 5, that could change this. But what would confirm this tomorrow, this breakdown, would be a close below 20, and a super strong confirmation signal would be a close below 10 or below 5.
Got it. Yep.
Move higher on these two, potential tepid reversal. And that's the way I see things.
So the next few days are pretty important, as you said.
Yep. And again, my guess is we meander and get neither because of election, Fed, economic reports. It's all pretty much out now. Earnings guidance, if we get a bunch of large caps forecasting Armageddon, that'll probably tip the market over. I think earnings guidance is the one thing pre-Fed that could do it.
Okay. That makes sense.
Because if the Fed is out of whack with what the street is saying, you could see that dynamic, right? No, you don't understand. We're not collapsing some point in the future. We're collapsing right now.
Right.
While inflation is high.
Right.
You imagine that scenario.
Fed's cornered.
Yep. Fed's cornered. So I'll probably get my next cheat sheet out. It won't be tomorrow. It'll probably be Tuesday, meaning Tuesday after the close or Wednesday before the open. So that'll give us a couple of days for this to play out.
Excellent.
But if you can't wait for me, now you know what to look for on the TD Ameritrade market forecast, which you can set up on your trading charts.
Perfect.
Double, it's been real.
It's been fun, man. Great conversation today.
Yeah, a long one, but for all two of you who stuck with us, we appreciate it.
That's right.
All right. See ya.
Next week. See ya.